Our next guest says market dynamics have shifted from fundamentals, fear in the Fed, to fundamentals and fanfare. For more on the markets, let's bring in JoAnne Feeney, partner and portfolio manager at Advisors Capital Management. I wish there was a treatise or a how-to on when sentiment moves from way too negative to positive, and then too positive, where we are along that continuum. Because initially, it might be okay when people suddenly give up on the bear thesis. We're not going to test the October lows. We're not going to do that. And then they start getting more positive. The market broadens, but then you start worrying about too much bullishness. Are we there yet, JoAnne?
Yeah, good morning, Joe. You have to remember how we got here and how bad things were over the last couple of years with all the volatility. So some of the rally we've seen has simply been recovery from for stocks that were simply sold off too much, that were trading below their intrinsic value. And so instead of looking at the whole picture, where is the market, where is the level, what we try to do is focus on individual stocks and companies and where their valuations are sitting. We still see a lot of opportunities here, particularly because of the path of interest rates and what we see going forward. And obviously that's been a lot of the broader rally, is the forecast that interest rates are going to start falling or at least go no higher. And so, yeah, there are opportunities still, even with that fanfare, Joe.
But if you did have to make a macro call, you say fanfare, and we're in a better place. People are no longer talking. Some people still are. We had someone a couple of weeks ago still talking about 3,500. On the S&P, a technician, I think he was from, can't remember, I'm not going to say, but one of the major firms. So there are people still around like that, but I think most people are at 5,000 for next year or thereabouts for the S&P. Is that good or bad? And where are you?
Yeah, so we're not making a market call because we just invest in like 35, 45 stocks. So we can, say, look, the market will do. What we want to do is focus on the fundamentals. And so it's fundamentals and fanfare, Joe. And what we saw out of earnings season was encouraging in some ways. On the other hand, the FedEx results, right, show that there's some slowdown going on, and we expect that to continue. So the big picture in our view is that the economy is pretty resilient. Consumers are resilient. They're still sitting on some savings. And more importantly, they have jobs. And those jobs are giving them the opportunity to continue to spend. And we've seen a normalization now in what they're spending on services as well as goods. And so that's encouraging going forward. And now we have probably interest rates have topped out, likely seeing some cuts coming up eventually. We think the market's a little bit ahead of the Fed here. But when you look at the growth drivers fundamentally, you do see opportunities from AI. You do see opportunities in healthcare, particularly life sciences tools, that really got beat up last year because of those higher interest rates. We think that's an opportunity. And then if you look at moderate dividend payers, they were really hurt when investors substituted out of sort of slow growth, 3 to 4% dividend payers over into bonds. We think that's a trade that likely reverses this coming year, and that gives some support to stocks that really sold off: utilities, staples, even some energy.
So what did you say, 35 to 40 names? What's your biggest, what are your top 5 holdings right now?
Yeah, it'll vary by strategy. So we have a growth strategy, we have small mid-cap, we have international strategy, we have balanced. Some of our top holdings will look familiar to those looking at the market. Broadcom is actually one of the biggest holdings at the firm across all of the variety of strategies. The reason for that is because not only do they pay an attractive dividend, but they also can generate pretty substantial growth, as we've seen. In fact, the stock has doubled over the last year. So that's a big holding, both for our income strategies and for our growth strategies. We do hold Microsoft in a substantial way. We hold Amazon. And so it really varies. But in income with growth, which is more dividend-oriented, like 6-7% yield, obviously that's going to be skewed more towards financials and energy and business development companies and REITs. So it really depends on the strategy and what our clients need. Some of them want the income, some of them want the growth. And that's why we pick 35 to 45 or so stocks to basically tailor the strategy for what the client really wants to live with.
Just can't avoid the Fed for some reason. It's, again, the lead story in the Journal. And we're going to have Kevin Warsh on. I've watched Austin Goolsbee. He was on Squawk Box. I've also seen him on making the rounds. And he's out there for a reason, to sort of tamp down expectations, I think. And I guess my question is, you think that we've driven a stake into inflation? Have we vanquished inflation? Because this could be what a stop-start mistake looks like. No one knew back in the last time this happened when the Fed would go up, they'd say, we think we're done, and all of a sudden inflation would come back, then it'd go up again. And it was that stop-start thing that really killed markets. Are we absolutely sure that this last mile, that we're going to conquer it for inflation?
No, Joe, we're not, and neither is the Fed, in our opinion. The Fed recognizes that inflation has not yet come back to target, and there's still more work to do. And yes, Austin Goolsbee and others are out there saying, look, you guys don't assume this is done. The Fed is going to stick with the higher for longer as long as it takes in order to drive the inflation back to its 2% target. So we do think the market's ahead of this. Moreover, we think a lot of people are misinterpreting those dot plots. Those dot plots are not a forecast of the policy path, right? Those are a survey of the economists at the different Federal Reserve banks and the Board of Governors as to what would happen if things played out exactly right. It's not a Fed policy forecast, so you have to be careful about building in too many rate cuts next year. The labor market remains pretty tight, 1.3 jobs for every unemployed person. It's better than it was, but we're not done in terms of taking the pressure off of wages, which ultimately feed into prices. So we think the Fed still has more work to do. We think the Fed is going to stick to its guns, and so that's why we do think the market is getting a little bit ahead of itself in terms of rate cuts. That said, we don't think rates are going to go much higher, if at all, from here, and that eases the pressure on high valuation growth stocks going forward, and we think it takes the pressure off a lot of those life sciences tools companies that were really hurt by the funding challenges of high interest rates. We think that starts to ease, given the strong demand background for a lot of those companies.
Yeah, we're out of time, but JoAnne, the only thing I was going to add to that is you look what's happening in the Red Sea right now, and with shipping costs jumping immediately, that does raise the question of whether inflation is going to be back on the global scene quickly.
Yeah, and how that feeds into potentially oil prices, Becky, right? And that is a concern. So the Fed has more work to do, and everybody should recognize that.